I think we've all seen or heard of people falling into some of these accounting minefields that end up costing them dearly. So in today's video, I am going to highlight 7 of those accounting minefields that you need to tread lightly through so that you can avoid costly mistakes. Let's get into it. No. 1. The first accounting minefield to watch out for is related to your chart of accounts. So, your chart of accounts is basically the list of all of the accounts in your accounting system that are used to categorize transactions. For example, your asset account, liability account, equity account, revenue account, and expense account. All of those fall under your chart of accounts. And one of the biggest mistakes that I see business owners make is not having an adequate chart of accounts. Now, what does that even mean? Well, there are 2 aspects to this. One is that they don't have enough accounts within their chart of accounts to properly classify transactions. And the second aspect to this is that they don't have enough detail within each account. For example, if you were to look at your P&L, you would typically see something called cost of goods sold, which is a pretty broad category. But what actually gets recorded to that cost of goods sold account will vary from business to business, because different businesses have different cost structures. So some businesses might allocate raw materials or cost of labor directly to that cost of goods sold account, whereas another business with a completely different product might allocate cost of labor as an expense. So how do you know which one is correct? Well, it really depends on the type of business that you run. And ultimately, the way that you choose to record that cost is going to impact your bottom line. So the key takeaway here is to make sure that you spend the time up front to set up a chart of accounts that's going to work for you now and in the future. Now the good news is that it's very easy to add new accounts. If you feel like you need more detail later down the road, the next accounting minefield to watch out for is related to owners' distributions. Now, depending on your business structure, you may be required to pay yourself either a salary or a draw. And one of the most common mistakes that I see business owners make is that they forget to take drawings from the business. Now, when you forget to take drawings, what that means is that the equity in your business is going to be higher than what it should be. And by doing so, you're also going to pay more taxes than you need to. Now let me show you exactly what I'm talking about. So in this example, we have a sole trader business where John has $100,000 of profit for the year, and assuming he pays tax at a rate of 30%. The third accounting minefield to watch out for is one that most business owners fall victim to, and that's the failure to reconcile bank accounts. Now, reconciling your bank accounts simply means comparing your ending balance in your accounting software to what your bank statement shows. Now, many business owners fail to do this on a monthly basis, which leaves them open to a lot of potential errors and even fraud. For example, a transaction might have been recorded twice, or a payment might have been recorded in the wrong amount. Reconciling your bank accounts on a monthly basis is critical in identifying these types of errors early so that you can fix them before they become bigger problems. The fourth accounting minefield to watch out for is over or under budgeting. So whether you're looking at cash flow, revenue, expenses, or profit, the one thing you do want to do is compare actual results to budgets that are outdated or inaccurate. And one of the most common reasons why business owners fail to stick to their budget is because their budget was overly complex. It wasn't realistic, or they just didn't have time to manage it properly. So here, a few tips that can help you create a budget that you can actually stick to. The first is to keep it simple. If you have a complex budget, you are more likely to make mistakes when entering the numbers, and you also more likely to give up on maintaining the budget altogether. So try your best to keep your budget as simple as possible. The second tip is to make sure it's attainable. So setting unrealistic budgets will only set you up for failure. So it's important to set realistic goals that you can actually achieve. The third tip is to involve everyone. When creating the budget, get input from everyone in the company so that everyone is on board with the plan. This will also help ensure that the budget is both attainable and realistic. And the final tip is to review and adjust regularly. Your budget isn't set in stone, so don't be afraid to review and adjust it as needed. In fact, I recommend reviewing your budget, at least on a quarterly basis, so that you can stay on track. The fifth accounting minefield to watch out for is failing to recognize prepaid and accrued expenses. So what we have here is an example of a prepaid expense. So let's say that on January 1st, our business paid $6,000 for 6 months of rent in advance. Now, in the accounting world, we call this a prepaid expense because we have paid for an expense that has not yet been incurred. So in this example, we have prepaid 2 months of rent. So $2,000 worth of rent has been expensed, but the other $4,000 still needs to be so at the end of the month, we need to make an adjusting entry to recognize the $4,000 of rent expense for the month of January. Now here's another example of an accrued expense. So let us say that we received an invoice for $2,000 of utilities that are due at the end of the month. Now, in this situation, we haven't paid the utility bill yet, but we have incurred the expense. So at the end of the month, we need to make an adjusting entry to recognize the $2,000 of expense and also record a liability for the amount owed. Now, failing to recognize prepaid and accrued expenses will result in an inaccurate financial statement, so it's important to make the appropriate adjusting entries at the end of the month. The sixth accounting minefield to watch out for is related to inventory management. So many business owners struggle with managing inventory levels, which often leads to inaccurate financial statements and lost profits. So, here's a few tips that can help you avoid this accounting minefield. The first tip is to use an inventory management software. There are a number of inventory management softwares available that can help you track inventory levels, automate reordering, and generate reports to help you make informed decisions. The second tip is to regularly count inventory. Regularly counting your inventory is critical to ensure that your records are accurate. I recommend counting inventory at least once a year. And the third tip is to analyze your inventory turnover ratio. Your inventory turnover ratio measures how quickly you're able to sell your inventory. A low inventory turnover ratio means that you're not selling your inventory quickly enough, which could result in lost profits. So it's important to analyze this ratio on a regular basis and make adjustments as needed. And the seventh accounting minefield to watch out for is the failure to separate business and personal expenses. Now, this is a mistake that many business owners make, especially those who are just starting out. They may commingle business and personal funds, which can result in a lot of headaches down the road. For example, you may deposit business revenue into your personal bank account, or you may use your business credit card for personal purchases. Now, this may seem like a harmless mistake, but it can easily lead to confusion and even fraud. So it's important to establish clear guidelines from day one. This will help ensure that business finances are always accounted for properly, and it will make tax time much easier. So there you have it, 7 accounting minefields that you need to tread lightly through. Now, these are just some of the most common accounting minefields that business owners fall into, but please keep in mind that this is not an all-inclusive list. So if you think there's a minefield that we missed, please leave a comment below and let us know. Now, if you found this video helpful, please give it a thumbs up and share it with your friends. And if you're new here, please hit the subscribe button so that you can join our growing accounting community. Thanks for watching, and we'll see you in the next video.